Hello students. Today we are start our unit number first, that is basic of accounting and computerized accounting. Meaning and definitions of accounting. Accounting is the art of measuring, communicating and interpreting financial activity. Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money transactions events which are in part at least of financial character and interpreting results thereof. Okay, so accounting is an art of recording, classifying, summarizing the business transaction in the books of account, and it is useful for the outsiders or to prepare a results for the use of outsiders. Okay, is known as accounting. Okay, so here recording means the underlying purpose of accounting is to provide financial information about the economic activity, and therefore only the transactions which can be expressed in monetary terms are recorded systematically and in an orderly in the books of accounts. Non-monetary transactions have no place in accounting. Okay, so only monetary transactions are recorded in the books of accounts. Recording of monetary transactions, or only monetary transactions are recorded in the books of accounts for the use of outsiders or to interpreting the results for the use of outsiders who have invested their money in the business is known as accounting. Classifying means classifying is a systematic analysis of the recorded data so that items of like nature are grouped under appropriate heads. For this purpose, ledger accounts are maintained. For example, all cash transactions are grouped under the head of cash account or cash book. Classifying means that the transactions are classified according to the nature of the transactions. Here example, all cash transactions are grouped under cash account or cash book. Okay, it's known as classifying. Okay, summarizing means the financial information collected is classified and recorded respectively heads of ledger accounts. Then the classified data is summarized in such a manner that it becomes useful to the internal and external users of accounting statements. Okay, at the end of the stipulated period, balances of ledger accounts are extracted. A trial balance is prepared by grouping these balances under two columns, debit and credit. Okay, summarizing means collecting the information or collecting a financial information and classified this information according to the heads of ledger accounts. Okay, so heads of ledger accounts means make a group. Okay, for example, cash account, cash book. Okay, so these are the ledger accounts, and then we post the journal entries into the summarize accounts. Okay, is known as summarizing. Then interpretation. Interpretation means of creating accounting information. The final accounting step is the interpretation of the summarized data in such a manner that the end users can make meaningful judgments about the financial condition or the profitability of the business. Judgments about the financial condition, profitability of the business operations, or can use the data in preparing future plans and laying down policies to execute such plans. Analysis refers to the process of fact finding and breaking down complex set of figures into simple components, while interpretation stands for explaining the real significance of these stipulated components. Okay, so interpretation is the final step of accounting. It is useful for the outsiders to know the financial position of the business organization. Okay, is known as uh, interpreting or interpretation. Now we are going to discuss the importance of accounting. First, to keep a systematic and permanent record of all the transactions. Second, to keep a record of income and expenses in such a manner that net results of business can be quickly known for any period. To keep record of assets and liabilities so that the financial position of the business on any day can be ascertained. Fourth, to provide necessary information about efficiency of the management in respect of utilization of the resources. Fifth, to keep control on expenses to minimize the expenses. Okay, these are the importance of accounting. Accounting is helpful to keep a systematic and permanent record of all the business transactions. Accounting is useful or beneficial for the business organization to record income and expenses of the business organization. Uh, okay, it helps to find out the net results of the business can be quickly known for any period. Third one is to record of assets and liabilities so that the financial position of the business on any day can be ascertained. So uh, accounting is beneficial to the business organization to know the assets and liabilities of the business organization, and financial position of the business on any day can be easily ascertained or can be easily measured. Okay, fourth one, to provide necessary information about efficiency of the management in respect of utilization of scarce resources. And fifth one, to control on expenses to minimize the expenses of the business organization. Now we are going to discuss the accounting cycle. Accounting cycle. Now we are going to discuss the accounting cycle. Here, accounting cycle, business transactions, then we make the journal entry of business transactions. Okay, so here first business transactions. Okay, business transactions, then we make second journal entries of that business transaction. Then third, we prepare a ledger accounts or we post the journal entry into ledger accounts is third cycle of accounting. Fourth accounting cycle is balancing the ledger. Okay, it means to make the total of ledger accounts and the balancing amount is transferred to trial balance, or the balancing ledger is help to prepare a trial balance of the business organization. When we prepare a trial balance, then it is helpful the business organization to prepare a trading account, then profit and loss account. Okay, trial balance, we prepare the final accounts with the help of trial balance. Okay, so when we prepare a trial balance, we easily prepare a trading account, then profit and loss account, and last one is balance sheet. Okay, 8. So here these 8 are accounting cycle of the business organization. First is business transaction. With the help of business transactions, we are make the journal entries in the books of business or concern. With the help of journal entries, we prepare a ledger accounts or we post the journal entry into ledger accounts. Then fourth cycle or fourth procedure of accounting is to make a balancing of the ledgers, and fifth one is with the help of balancing the ledger or balancing figure of ledger account, we prepare a trial balance. Okay, and with the help of trial balance we prepare trading account, profit and loss account, and balance sheet of the concern is a accounting cycle of the business organization. Okay, then here transaction means the exchange of goods and services between two persons or parties for money or money's worth is known as transaction. Okay, transaction means exchange of goods and services between two person or parties for money and money worth is known as transaction. Here transaction has two types in transaction, that is a monetary transactions and second one is non-monetary transactions. Okay, so here monetary transaction means the transaction which involves an exchange of money or money's worth directly or indirectly is called monetary transactions. Only monetary transactions are recorded in the books of accounts. Okay, so monetary transaction means the exchange of goods or exchange of services between two parties for money or money's worth directly or indirectly is called monetary transactions, and monetary transactions are recorded in the books of accounts. Okay, so in monetary transactions there are two types of monetary transactions. First one is cash transaction and second one is credit transactions. Cash transactions means a business transaction in which cash is paid or received immediately is known as cash transaction. It means when we exchange the goods or when the business organization or any concern sell the goods on cash is known as cash transaction, or uh, exchange of goods against the cash and cash is immediately received is known as cash transaction. For example, purchase of goods for cash at rupees 15,000. Okay, so here the person has purchased the goods for cash at rupees 15,000. Okay, it means he purchased a 15,000 goods and paid a 15,000 to a shop against the purchasing goods, immediately paid. Okay, immediately cash paid is known as cash transaction. Second example is payment of salary at rupees 5,000. Okay, so here payment of salary paid to workers or employee. Okay, so salary is immediately paid, it is a cash transactions. Okay, so these are the cash transaction or it is known as cash transaction. Second one is credit transactions. A credit transaction is one in which cash is not paid or received immediately at the time of transaction, but it is paid or received at a later date. It means the goods are purchased or sold on certain date and amount of that goods or services are paid on later date is known as credit transaction. For example, goods sold on credit to Mr. Aman at rupees 8,000 and the selling date is, for example, 1st January 2020, and the amount received on 1st February or 8th February 2020. 20. So it is a credit transactions because the goods sold on 1st January and amount received on next month or later date, okay, that is 8 February 2020, okay, is known as credit transaction. Second one is non-monetary transactions. Non-monetary transactions means the transactions which does not involve an exchange of money or monies worth directly or indirectly are called non-monetary transactions. Okay, so here non-monetary transactions does not include money or monies worth directly or indirectly. Okay, here non-monetary transaction means an exchange of one thing against the another thing is called as non-monetary transactions or barter transactions. For example, if we exchange a goods, okay, for example, we take a example of jowar and wheat. Okay, one farmer has producing jowar and another farmer has producing wheat, then they exchange these commodities, okay, against the jowar, okay, and wheat is known as barter transactions. Okay, so remember this, barter transactions does not include money or monies worth directly or indirectly. They exchange the commodities against another commodities. Okay, so it is known as barter transaction. Here entry recording of business transactions in the proper form or method in the books of accounts is called an entry. Okay, entry means recording of business transaction in the proper form or method, okay, is known as entry, or it is called as entry. Okay, so business transaction is recorded properly in the books of account is called entry. Second one is narration. Narration means a brief explanation of the business transactions for which an entry is passed is called as a narration. It is always given in the bracket below the journal entry and it usually starts with the word being or for. Okay, so narration is a brief explanation of business transactions. Okay, and it is given in the bracket below the journal entry. After passing the journal entry, we write a narration below the journal entry into bracket and the word is starting from being or for. For example, purchase of goods for rupees 15,000 on cash. Okay, so purchase of goods. Okay, so we make a entry. Okay, purchases account debit to cash account. Okay, we purchase the goods, purchases account debit to cash account, and here we write a narration for this transaction. Here being purchase of goods for cash or on cash amounted to rupees 15,000. Okay, so this called narration. Third one is goods. The term goods refers to mercantile commodities, articles, or things in which a trader trades. These are purchased or manufactured for the purpose of sale and to earn profit. Okay, goods is a commodity which is traded in the market for earn a net profit is called goods. For example, medicine are goods for the chemist, vegetables are goods for the vegetable vendor. Third, parts like tires, engine, gearbox, cables are produced by a vehicle manufacturer like Bajaj Auto, Hero Motors, etc. Okay, are called a goods. Okay. Next one is capital and drawings. Capital, the total amount invested into the business by the owner is called capital. Okay, so capital is the amount invested by the owner in the business is known as capital. Here excess of assets over liabilities is also called as capital. The equation for this is capital is equal to assets minus liability. The balancing figure is called capital of the business organization. Okay, so it is very easy to find out the capital of the business organization. Total of assets minus total of liability, we easily find out the capital of the business organization. Capital is a liability of the business, as this amount is payable by the business enterprises to the owner at the time of closure of the business. At the time of winding up of the business, the capital is repayable to the business enterprises, repayable to the owners. Okay, because the capital is a liability of the business enterprises, or the capital is the liability of the business organization, and it is repayable to the owners at the time of winding up of the business. Okay, is known as capital. Next one is drawings. The amount of cash or value of goods, assets, etc. withdrawn from the business by the owner for personal use is called as drawing. Okay, drawing means the amount or the cash, goods, assets are withdrawn from the business by the owners. Okay, for personal use are called drawings. It means the owner has withdraw the goods, owner has withdraw the cash from the business, because business is a separate and owner is separate. So if the owner has withdraw the money from the business, then it is called drawing of that owner, and it is deducted from the capital of the business organization, because uh, capital is a liability of the enterprises, and the capital is invested by the owner of the business organization. Debtors and creditors. Debtor means a person who has to pay to the business for getting goods and services on credit is known as debtors. A debtor is a person who owns money to the business. Okay, a debtor means a person who pays money to the business for getting goods and services on credit. Okay, so goods and services are taken on credit, then they paid this amount to the business after the transaction date is known as debtor. Same creditor. Creditor means a person whom business has to pay for getting goods and services on credit is known as creditor. A creditor is a person to whom business owns money. Okay, and third, bad debts. An irrecoverable amount from a debtor is known as bad debt. It is a revenue loss to the business. It means the amount is not recovered from debtors, then this irrecoverable amount is called bad debts. Okay, then expenditure and types of expenditure. So here expenditure and amount spent by the business for any consideration received by business is called expenditure. Here types of expenditure is capital expenditure, revenue expenditure, deferred revenue expenditure. These three are types of expenditure. Okay, so capital expenditure means this expenditure is incurred to acquire fixed assets or to increase the value of fixed asset. It gives the benefit for a long period of time, and it is non-recurring in nature. Okay, capital expenditure is a investment in a fixed assets or purchasing a assets for the benefit of long period is known as capital expenditure, and it is non-recurring. Okay, non-recurring means it is not incurred year by year. It is incurred uh, once in a 5 years or 10 years, depend upon the fixed assets of the business organization. For example, purchase of machinery, extension of building, purchase of computer. Once we purchase a machinery, okay, the benefit of that purchased machinery is long period. Okay, okay, after disclosing this machinery, the business or concern purchase a machinery or another machinery. Okay, so purchase of machinery is a capital expenditure. Extension of building. Once we build a building, we did not build a building yearly. Okay, so building is life of building is 10 years, 15 years, 5 years. Okay, so it gives a long term benefit to the concern. So extension of building or build a building is a capital expenditure of the organization. Revenue expenditure means revenue expenditure is an expenditure from which no future benefits is expected, but having immediate or short-term benefit may be less than 1 year. It does not increase profit earning capacity of an organization. These are normal day-to-day operating expenses of a business organization and appear on the debit side of trading account or profit and loss account. Okay, revenue expenditure means the day-to-day transactions of the business organization. Okay, that benefit is short term, may be less than 1 year. Okay, and it is recorded on the debit side of trading account. If the expenses is direct in nature, we record these expenses on debit side of trading account. If the expenses are indirect in nature or operating nature, day-to-day expenses of the business organization are recorded on debit side of profit and loss account. For example, rent paid, salary paid, wages paid, etc. Okay, are recorded on debit side or are called revenue expenditure. Third one is deferred revenue expenditure, and expenditure which is basically revenue in nature but benefit of which is not existed within 1 year is called deferred revenue expenditure. Such expenditure is written off over number of years. Such written off amount is shown on debit side of profit and loss account, and unwritten amount is shown on asset side of the balance sheet. Okay, heavy expenditure on advertisement, heavy legal expenses. Okay, these are the deferred revenue expenditure. Deferred revenue expenditure is, or it means, the expenditure incurred uh, at the time of foundation of the business organization, and it is recorded on the asset side, uh, balance sheet, asset side under the head of fictitious assets. For example, preliminary expenses, advertising. Uh, okay and it is written off from profit of the organization, and unwritten amount is written on asset side of balance sheet. Okay, are known as deferred revenue expenditure. Cash discount, trade discount. Okay, trade discount means it is an allowances given on catalog price or list price of goods. This discount is allowed at the time of purchase or sale of goods. Value of goods purchased or sold recorded is net value payable, that is after deduction of amount of trade discount allowed. Okay, it means trade discount is not shown in the books of accounts. Only the amount of discount is deducted from the catalog price of the goods. For example, if we purchase a goods of rupees 1000, and uh, if goods of rupees 1000 are sold at 5% trade discount, the value of goods that will be recorded in the books of account is 9000, sorry, 950. Okay, it means only deduct the amount of trade discount. It does not record, or trade discount is not recorded in the books of accounts. Okay, so here 1000. If we if goods of rupees 1000 are sold at 5% trade discount, then only the entry will be sales account debit. What is the entry? Sold. Cash account debit to sales. Okay. And amounted to rupees 950. Okay, is known as cash trade discount. Cash discount is here exactly opposite to trade discount. Okay, cash discount is recorded in the books of accounts. If we sold a goods, so here sold goods, the entry will be 1000. It means cash account debit 1000. Discount is our expenses, so discount account cash account is uh, cash account debit rupees 915, discount account rupees 50, and to sales rupees 1000. Okay, so cash discount is shown in the books of accounts, but trade discount is does not shown in the books of accounts. Okay, solvent insolvent is not necessary. Then utility of journal entry. Okay, journal entry, we understand the meaning of journal entry. Okay, importance of utility of journal entry is here specimen or pro forma of journal entry. If here pro forma journal entries in the books of dot dot dot, whatever the name of the concern, date 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 is given in the transactions, and according to these transactions we make the journal entries in the books of journal. Okay, so here particulars, date, particulars, lf means ledger folio, debit amount rupees and credit amount rupees. Here in date column we write it date. Here in particulars column we make the journal entries. In ledger folio, we write it here the number or number of accounts, okay, which is given in the ledger folio. Okay, we easily find out this entry in the ledger book, and the debit amount and credit amount. Then here debit account, credit account. Okay, so read it here, source document. Now we are going to start a shortcut keys of the tally. Okay, tally means it is a accounting software. How to create a company? So it is very easy to prepare a company in tally software. Here we only read the or understand the shortcut keys of a tally. Here receipt voucher, the shortcut key is F6. Okay, remember this. For receipt voucher, shortcut key is 6, F6. Payment voucher, the shortcut key is F5. Okay. For contra vouchers, the shortcut key is F4. Okay, here F4 is given here. Okay, for contra voucher, uh, shortcut key is F4. For journal voucher, the shortcut key is F7. Okay, uh, so and purchase voucher entry, the shortcut key is F9. Okay, so remember these shortcut keys. Okay, uh, so these are the first unit. Okay, so read this theory properly and remember these shortcut keys, as well as how to make ledger posting, journal entries. Okay, so read all the theory carefully. If you have any query, then ask me. Okay, thank you very much.